What does the budget mean for me and you, everyday savers and investors? Well, currently it's 2:30 in the morning, and I just thought I'd take a lot of time to absorb everything that's gone on during the day and what it's going to do for people like myself and people like yourself. So without further ado, let's get into it. So first off, let's talk about cash ISAs. Now, it won't shock anyone who's been following the pre-budget chatter that the annual cash ISA limit is being trimmed to £12,000. Now, unlike many other days, other announcements, this one isn't about plugging holes in the nation's finances. Instead, it's part of a bigger effort to refresh the ISA system and gently encourage people to think longer term with their money. Now, the aim is simple. Help more savers benefit from the kind of growth that the stock market investing can offer. And the difference can be huge. So over the last decade, £10,000 left in cash would have earned £863. Put that same amount into a fund following the FTSE 100 with the income reinvested, and it would now be worth £22,395. Cash feels safe, but that safety can come at a substantial cost, especially if inflation continues hovering above the Bank of England's target. One surprise in today's ISA change is that there's a carve out for savers aged 65 and over who can still put the full £20,000 into a cash ISA. Yes, this move avoids alarming some parts of the media, but it also makes sense. The government wants younger savers who have time on their side to consider the long-term boost that investing can provide. It's also good news that the government dropped the idea of forcing ISA investment into UK assets, which is good. International evidence shows that those kind of mandates usually do more harm than good. Instead, investors who want to back British companies will be helped to do so without unnecessary complexity, which is really nice. Something I did think of was, if they are going to take £8,000 away from the cash ISA, they should just give it to the stocks and shares ISA and give us 12 and 28. But I'm not a politician, so yeah. Now, next up is freezing income tax. Oh, and also it should be mentioned, just whilst we're talking about stocks and shares ISA, there's no change to the annual contribution limit to the stocks and shares ISA, but the cash ISA has been reduced to 12,000, and that is just to try and encourage people to invest a little bit more money. Now, freezing income tax threshold. So the biggest revenue raiser in the budget comes from extending the freeze on income tax thresholds for another 3 years. Now, it doesn't look like a tax rise on paper, but its effects are very real. So as wages grow, more people are quietly pushed into higher tax bands, as you can imagine, generating an estimated 12.4 billion by 2031. Since 2020, the number of high rate taxpayers has already jumped by 78%, and about 1 in 5 people now pays higher or additional tax, which is nuts. The thresholds introduced in 2021 were already set to stay put until 2028. Now they're going to be frozen until 2031. So if the higher rate threshold had kept pace with wage growth since 2000, it would be around 69,000 today, not just slightly above 50. This fiscal drag means a typical higher rate taxpayer is already paying more than 8,000 extra each year, and that figure is only heading upwards. For the government, the political risk is quite clear. The people who feel squeezed aren't the wealthiest, but those earning around £50,000, many of whom don't feel well off. So the fiscal drag thing, so if you freeze the bands, but over time everybody's wages will continue to rise. So if the bands are frozen here and your wages rise, everyone's going to be pushed into higher and higher tax bands, and that is more money that the government can come and grab. So say it's frozen £12,000 and then you're earning 24,000 and then 28,000 and then 30,000, more and more and more of your income is going to be over that £12,000 that the government come and tax. That's fiscal drag. And that's going to be frozen out until 2031. Okay, another thing, targeting high-end property. So politically, tapping into the value of high-end homes is one of the easiest measures to defend. The new property surcharge will apply to homes worth more than £2 million, aligning with the idea that those with the broader shoulders can carry a bit more. However, it won't bring in huge sums, around 430 million by 2031. It's a big amount to me, but to the government, maybe not so much. The tax will be added as a surcharge to council tax bills. So, though not until April 2028. So owners of £2 million homes can expect an extra £2,500 a year on their council tax, while £5 million properties will attract an extra £7,500. Now, the Chancellor also plans to consult on letting homeowners delay payment until they sell. Now, while helpful for cash-poor, asset-rich households, this could weaken the measure's ability to deliver revenue quickly. It might also discourage older homeowners from moving, potentially tightening an already strained housing market. For bond markets, timing matters just as much as the size of the tax rises. These big measures can feel helpful, but not immediately. So yeah, that's another big thing that I think came out of it. Now, higher tax on savings, dividend and property income. Now, for people who watch this channel, this is probably going to affect you the most. So aside from the ISAs, so perhaps the biggest curveball was a 2% increase in the tax rate on savings held outside of ISAs or pensions, with the same rise applying to dividends and property income. So just the dividend tax uplift alone is expected to raise 1.4 billion by 2031 for investors. This is yet another nudge to make use of the full ISA and pension allowances wherever possible. Now, how the market's reacted. So beyond voters and MPs, the Chancellor had one very important audience to satisfy: the financial markets. So with every 1% move in borrowing costs, costing the government around 17 billion, keeping investors calm was crucial. So markets were looking for reassurances that there's a comfortable buffer in public finances. Tax rises are paired with credible spending cuts. The tough measures aren't all delayed until just before election. Nothing in the budget stokes inflation. Borrowing won't have to jump, and this isn't the start of regular repeated tax hikes. Now, more than anything, markets wanted to see signs that confidence in the UK economy can come back to life. Now, during the speech, this is really interesting, the pound actually edged up to around $1.32. The FTSE 100 saw a modest rise as well, and the FTSE 250, which leans more on the UK economy, climbed about 1%. So, not terrible, actually. Overall, the Chancellor will likely be relieved by the market response to what was always going to be a tough second budget. But while backbenchers may be satisfied, businesses, middle-income earners and everyday investors, savers, might feel far less cheerful, and that is probably a lot of people who watch my channel. So the big takeaways are the stocks and shares ISA, that's staying at £20,000, but if you utilise a cash ISA, that is being cut as of April to £12,000. So that's I think the big takeaways for me. It is now 20 to 3 in the morning. I'm going to edit this video. I'm going to get it up tomorrow for you as soon as I can. But yeah, let me know what you think the big moves were here. If it's good for you, if it's bad for you, yeah, let me know. Now, if you guys want to see my own dividend portfolio, which I'm going to start paying tax on if it ever does go outside of the ISA allowance, a little bit more, 2% more. I'll leave that video link right there. But apart from that, I'm Steve. This is the Extra Income Boss. Thanks for watching. Happy budget. See you in that one. Peace.